better. All right. Good afternoon, everybody. Uneducated Economist here. And so in this video, we are going to be talking about inflation expectations and how the strangest reality that we now face here within the economy is that elevated inflation expectations actually is very supportive of the market. Now, a lot of people will find that very counterintuitive to what it is that they believe has taken place when you have elevated inflation expectation, which generally puts a burden on the individual, on the consumer, on the working class, working class stiff who's trying to figure out how to make their paycheck go, a little longer throughout the month. Elevated inflation expectation is the pain that they are experiencing. So something that I have been trying to share on this channel for many years now is how the Federal Reserve has switched their monetary policy from adjusting the Fed funds rate to talking about adjusting the Fed funds rate, and how that talking about the Fed funds rate is more of the monetary policy that we now face. So having elevated inflation expectations, how does this actually support the market? Well, you have to think about something called the neutral interest rate, and the neutral interest rate is the rate that the Federal Reserve is neither accommodating nor restricting the economy. It's when that they are neutral. When they raise the Fed funds rate, they are moving it above neutral to try and restrict the economy. Now, this is pretty simple for most people to understand, but when it becomes very difficult to understand is when that neutral interest rate begins to move. Now, nobody can go and focus in on the neutral interest rate because there is no place to go to see the neutral interest rate in real time. It's more of a shadowy, kind of behind the scenes interest rate, and a lot of times people will refer to R star or go to R star as far as the Federal Reserve's estimate of the neutral interest rate, and the R star is really the gap between the neutral interest rate and where the current Fed funds rate is. So when you see the neutral interest rate, or at least the R star from the Federal Reserve's estimate falling, that's the gap between the two getting smaller. So either one, the Fed funds rate is coming down, getting closer to neutral, or neutral is rising ever closer to the Fed funds rate. Hold on one second, guys. I am going to turn my hopefully that's a little better. When I have my Wi-Fi on, it gets real glitchy here trying to hook up with the store's internet. So that's going to be a little better for you. Today I'm going to share a little bit of a Federal Reserve speech to try and help us understand what it is that the Federal Reserve is looking at or looking towards going into the future, especially when it comes to the inflation expectation. So knowing that the Federal Reserve is trying to elevate the inflation expectations in order to raise the neutral interest rate, by raising that neutral interest rate, getting ever closer to the Fed funds rate, making the economy less restricted, pushing elevated inflation expectation is essentially the key to this, right? Now, they're not going to come directly out and tell you, hey, we are going to push elevated inflation expectations. If they were to do that, it wouldn't work. The whole thing would fall apart. So a lot of this is hidden in secrecy as far as their communications and how it is that they are deliberately communicating in order to achieve the outcome that they are looking for. And ultimately, right now, they are pushing for an elevated inflation expectations. Now, what ends up happening is that if you have an elevated inflation expectation, you will push for higher returns on your capital investment. Now, if you're getting a decent return on your capital investment, like you putting money towards a particular interest-bearing account that's actually having a return, at the same time you have low inflation, like low actual inflation, not low inflation expectations, but low inflation itself, then what this is an actual boost to the economy. People are getting a decent return on their capital investment, and they're able to deploy that into an economy that has low prices. Now, I know a lot of people are going to argue with the whole idea of whether or not we are experiencing price inflation or increased inflation, or if it's going to go into hyperinflation. The individual person can feel a lot of pain on the high prices, but when it comes to understanding monetary policy coming from the Federal Reserve, we really have to look at the things that they are looking at so that we can understand what it is that they are planning on doing, so that we can make the most appropriate decisions for ourselves based on that expectation that is coming from the Federal Reserve's monetary policy. Does that kind of make sense? So understanding what the Federal Reserve is trying to do or look at as far as their monetary policy goes gives us a better understanding of what it is that we need to do. We could tell them, hey, you need to look at these numbers, you need to look at a better, look at unemployment in this way, and then say, hey, that would be more accurate. And that very well could be true, but they're not going to look at the things that we are telling them to look at. We have to look at the things that they are looking at so that we can understand what it is that they are planning on doing. Okay. Now, I'm getting this from Christopher Waller's speech. It was given June 1st, so just a couple of days ago. The entire speech is really good. We're going to break this entire speech down in a member-only live stream at some point, probably this weekend. But as far as today goes, I'm not going to break down the entire speech. I'm just going to break down a section of this speech. Again, this is Christopher Waller, June 1st, 2025. The effects of tariffs on the 3 I's: inflation, inflation persistence, and inflation expectations. Now, I'm going to zip down to the inflation expectations part of the speech, and we're going to start breaking this down. I'm going to read through it. I haven't really read this yet. I just kind of looked over it real quick. I think there's some good information that we're going to get from understanding how it is that the Federal Reserve is looking at inflation expectations. And remember, if you raise the inflation expectation persistently, dramatically, consistently over time, it will raise that neutral interest rate. And if the Fed is standing still, it's making the economy less restricted. See, sometimes I think about this when it comes to what we have experienced over the last 5 years, especially considering what was being pushed out there through the mainstream media and through a lot of people's narratives about the Biden administration, how idiotic he was, how he's causing all these problems. I mean, the list went on and on. Like, he doesn't even know what he's doing. He's a mumble, he's not even coherent in the things that he says. All this that was pushed out there constantly elevated the inflation expectation. And if this theory is accurate, which I believe it is, it's probably the most accurate theory that you could ever possibly find, because this is coming directly from the Fed itself, is that all that time raising that or having that elevated inflation expectation over time was raising the neutral interest rate, and over time the economy became less and less and less restricted. And people wonder why it is that we didn't have the recession, why it is we had such a resilient economy. They wonder why it is that things are cooking along the way they are and we haven't had a crash yet. And all those people who are asking that question probably do not understand the information that I am providing for you today. If they understood this stuff, they wouldn't be asking that question. Let's break this speech down, guys. Okay, inflation expectations. Again, this is from Christopher Waller, given June 1st of this year, just the other day. It says here, now let's discuss the second issues of diverging inflation expectations. So basically, he breaks it down that there is 2 inflation expectations that are happening now. Okay? I have argued that I believe that the tariff-induced inflation will be transitory, and we should look through it when setting policy as long as long-term inflation expectations are anchored. Now, this is something that I thought was pretty interesting, because the long-term inflation expectations are well anchored, but the current inflation expectations are extremely elevated. This is exactly where they want the people to be. They want them to believe that the long-term goal of 2% is still achievable, which most people do feel that's the case. I mean, even through the surveys. But the current inflation expectation is quite elevated. Again, this is very much what the Federal Reserve would be looking for if they were trying to push the elevated inflation expectations within the economy while maintaining long-term anchored inflation expectations at 2%. So keeping that locked in while at the same time elevating the current inflation expectations. By doing this, you can raise that neutral interest rate, make the economy less restricted, and this is very stimulating to the economy. Right? And in fact, it's less restrictive. I shouldn't necessarily go into stimulating. All right, continuing on. Okay, however, right now we are seeing a dramatic disparity between household measures of inflation expectations and market-based measures, as well as the inflation expectations of professional forecasters. The University of Michigan surveys of consumers show that both near and long-term inflation expectations have increased strikingly. Remember, if you were trying to push for elevated inflation expectation to raise the neutral interest rate, that's what you would be looking for. This is exactly what you would be wanting, is consumers show that both near and long-term inflation expectations have increased strikingly, right? And again, this isn't the actual inflation, it's inflation expectations. All right, moving on. On that, in the past few months and currently stand at 6.6% and 4.2% respectively. That's quite elevated inflation expectations. Meanwhile, inflation expectations measured based on prices of nominal versus inflation adjusted securities have not increased very much. With 2-year Treasury inflation protected securities inflation compensation around 2.7% and a 5-year and 10-year around 2.4%. Also, the median from the survey of professional forecasters for consumer price inflation of 6 to 10 years ahead at 2.2%. So going off of these professional survey measurements of inflation expectation, it is very subdued. It's down at 2.2 and 2.4 and 2.7. Meanwhile, household inflation expectation is quite elevated. There's the two different expectations that are happening, right? But again, the consumer, right? The consumer shows that both near and long-term inflation expectations have increased strikingly. And again, by increasing this part strikingly, it'll pull the neutral interest rate higher. The highly unusual discrepancy, sorry guys, the highly unusual discrepancy between inflation expectation measures creates problems for the policymakers. I don't think so. I think this is actually solving a lot of problems. They want to call it a problem because by calling it a problem, they actually push the inflation expectations even more as people fear the uncertainty and doubt that comes from it. Okay? Problem for policymakers whose expectations should be, okay, hold on. Let me read this again. The highly unusual discrepancy between inflation expectation measures creates problems for policymakers whose expectations should be paying attention to, or whose expectations should we be paying attention to? That's the question he asked. I prefer to look at market-based measures of inflation compensation and professional forecasters' expectations because they have money on the line, and those buying inflation-protected securities lose money if they get it wrong. Professional forecasters have clients and firms making financial decisions based on those forecasts and will lose customers if their predictions are wrong. As I used to teach my students, in a capitalist system, competition will drive firms out of business if they make bad decisions. Forecasting mistakes can be costly for customers, but households aren't competing with each other and won't be driven out of business if they make bad decisions. So this is pretty interesting to think about. Like, he looks at the inflation expectations, the reality of the inflation expectations through the professionals, saying because they have money on the line, their idea of inflation expectation, like they will lose their business, lose their job, lose their income if they get this decision wrong. He trusts that decision more than that of the households who are not in competition with each other, but literally stuck in their own mindset. All right? Does that make sense? Like, you're not competing against the other people, so whatever decisions you're making them off of your own decisions, not necessarily one off a competition. Okay? So getting it wrong is only your problem. When these get it wrong, it's a much bigger problem. All right. But for the sake of arguments, let's assume that household measures of high inflation expectations are correct and financial market participants' expectations are too low. What are the implications of this mismatch? If households actually believe inflation will be 7% over several years, workers would expect to demand at least a 7% raise to keep their real wages from falling. If firms grant those wage demands, then the inflation would rise by roughly 7% as the wage increases are passed through. Also, job search and quits rates should increase because workers are looking for higher paying jobs. If this is happening, or sorry, is this happening? That's the question. Although that was the story a few years ago, in a tight labor market, I am not now hearing about such an upturn in wage demand from my business contacts, and I don't see it in wage compensation data. Basically saying that the feelings of high inflation coming from that particular sector, like the working people saying, hey, we feel inflation is going to be very persistent, they would demand a higher return on their or a higher compensation for their wages, and then push the inflation higher. He's saying that doesn't exist. That's not what's happening right now. All right. Also, job searches and quits would be okay, higher. Is this happening? Although that was the story a few years ago in a tight labor market, I am not now hearing about such an upturn in wage demand from my business contacts, and I don't see it in wage compensation data. After several years of outsized pay increases in a labor market that has loosened significantly from a year or two ago, I think workers don't have much leverage to ask for raises and are probably more worried about keeping their jobs right now. You see how this is working? You see, they're more worried about keeping their job right now. The reality of the situation is that the inflation is not coming. It's not here. It's not being pushed up by the higher wages. In fact, he's saying that it's exactly opposite of that, and that people are more worried about keeping their job than trying to find a job with a higher pay. See, that was a few years ago. We found people quitting their job in mass proportions, trying to go for that higher pay. Now, we're not seeing that as much. Will it change? Could, but right now, this is the situation we now face. There is elevated inflation expectations, but the reality of inflation is much lower than what the people's expectations are. Where was I? I already lost my place. Okay. Furthermore, outsized increase of the quit rates. Okay, here we go. Are more worried about keeping their jobs right now. Furthermore, instead of increasing, the quit rates is below its pre-pandemic level. Given labor market conditions, it seems hard to believe that high inflation expectations we are seeing in consumer surveys will lead to a large nominal wage increase and a second round burst of inflation. So those who understand this is looking at, or those who are understanding what it is he's saying. What it is that because the demand for higher wages is not being shown in the data right now, the idea that this is going to cause inflation going into the future doesn't exist. Like, you ultimately would want to see higher demand for wages right now within the economy to be the sign that there would be inflationary pressures coming into the future. He does not see that. So he doesn't see the inflationary pressures coming from the labor market, coming from higher wage demand. Okay? And again, the expectations are there, but the actual inflation is much lower. A second point here is that consumers believed we were about to face high inflation, right? The tariffs, credible threat of tariffs, persistent tariffs, constantly unloaded there into the mainstream media. A second point here is that if consumers believed we were about to face high inflation, they would be front-loading purchases sorry, this thing didn't print out very well. Much as importers seem to be front-loading their inventories. But on the contrary, the exertion of, what is this? Gosh, I'm sorry, guys. Something of motor vehicles. We haven't seen a broad surge in the consumer spending. Oh, I guess the exertion of motor vehicles. We haven't seen a broad surge in consumer spending, which overall is growing more slowly than it did in the second half of 2024. I think that's probably going to end up changing. In fact, we just saw reports on that coming from, I believe, Ford, that has seen an increase in new vehicle sales. But again, that's really based on, from the bottom. Like, if you have a 16% increase, what are you talking about? From the lows that you had or from last year, right? So you really have to look at where those numbers are coming from. On page 12. Okay. For financial businesses, they set interest rates on their loans and financial products based on expected inflation. Their views should be embedded in the market-based inflation expectations and those of the professional forecasters. If they got the forecast wrong and the nominal interest rates on their loans were too low, then their real returns would be dramatically reduced and their profit margins squeezed. I have had a hard time believing interest rates are mispriced so badly. If they were, then households would think that the real interest rates on loans is greatly suppressed. Consequently, loan demand for interest-sensitive products like houses, cars, and durable goods should surge. While loan demand appears to be healthy, there are no reports from bankers and other financial firms that loan demand is surging. Right? And I think this is probably something that is going to end up being one of the biggest misunderstandings for a lot of people right now is to think about how it is that the elevated interest rates has put a burden on the borrower, but not really thinking about how restricted the economy is right now. Like to borrow and do a project right now in an economy that is less restricted. This would be a very beneficial thing to whoever it is playing in that game to understand why it is. Like, here it is. I'm sitting on stage listening to Ken McElroy last weekend talk about how it is that he's getting these projects started and how it is that he's doing these things. And during a time in which that most people would think, man, why would you want to do this? Like, why is it that you are actually taking advantage of this particular environment and this opportunity? And yet, if you just explain it in the sense that the economy is less restricted now than it was last year or the year before. Right? This is probably one of the reasons why you're seeing such a resilient economy, is because the more it pushes the inflation expectation higher, the less restricted the economy is becoming. The more available it is to do these projects, the more profitable it is. If you have a decent return on capital investment and the prices are actually low, this is the economy that you would want to participate in. But most people can't see it that way because they're so locked into tariffs and problem of tariffs and issues that are coming from, a bad administration or previous administrations or whatever. They put this fear, uncertainty, and doubt that is so elevated that they just can't see this. Right? Knowing that if you believe in the elevated inflation expectation, if you know it, it's going to raise the neutral interest rate, and that's going to make the economy less restricted. It's amazing on how well some people will do in an economy like that. Okay. All right. Okay. Financial firms that loan demand is, okay. No reports of that. Okay, so based on wage demand, spending patterns, and loan demand, I see no evidence of an economic activity that confirms inflation views reflected in the University of Michigan household measures, which, like other polling about the economy in recent years, may reflect attitudes about other factors. In conclusion, given my belief that any tariff-induced inflation will not be persistent and the inflation expectations are anchored, and I think he's believing long-term inflation expectations on that one, I support looking through any tariff effects on the near-term inflation when setting policy rates. Fortunately, the strong labor market and progress on inflation through April gives me additional time to see how trade negotiations play out and the economy evolves. Assuming that the effective tariff rate settles close to my lower tariff scenario, the underlying inflation continues to make progress to our 2% goal, and that the labor market remains solid, I would be supporting, quote, good news rate cuts later this year. So if there's good news and you gonna cut rates on good news? Like, how could you possibly, like, the idea of good news means that the economy is performing well and that you wouldn't need to cut rates. But if the economy is doing poorly and you're moving into a recession and you need to stimulate the economy, you lower interest rates. So how could you be cutting rates into good news? See, good news would start lowering the neutral interest rate. If you start lowering the neutral interest rate because your inflation expectation has magically vanished away, tariff, problems are going away, they're no longer reporting it on the news, so people aren't got their panties all up in a bunch, then you start having inflation expectations coming down. Well, that will start restricting the economy more. Good news rate cuts? Well, that doesn't make any sense. I mean, good news means that there's not a recession, right? Bad news means there's a recession. So if you're cutting into good news, it must mean that the inflation expectation has come down and the neutral interest rate is falling. And they would have to follow the neutral interest rate down to keep the economy from becoming more restricted. See, this, understanding this from this sort of view is unlike anybody else's idea of how monetary policy is supposed to operate, except for the view of the Federal Reserve itself. This is where I got the information from the Fed, from the founders of this sort of monetary policy where they use perception-based leverage manipulation. This is the ideas of Ben Bernanke. This is the ideas of Michael Woodford. This is the ideas of Larry Summers. There's people who came up with this idea and this strategy, developed it decades ago. Here it is being deployed into the economy. Very few people can actually see it. We are one of the few channels who has even brought up the idea of a neutral interest rate and how it is that the Federal Reserve sets monetary policy in accordance to it. Most people have no idea that it even exists. This is the only channel that then looks at the psychological behavior of the markets when they have an elevated inflation expectation and how that relates to the monetary policy, considering the Federal Reserve was in desperate need of an inflation expectation that was persistently too high rather than too low. That's the words of John Williams from a speech that he gave back in November of 2018 called Monetary Policy Strategies for a Low Neutral Interest Rate World. Here we go, guys. We got it dialed in, right? We have this monetary policy so dialed in way, way more than anybody else does. And I'm not trying to brag it up like I'm some sort of super genius. You guys really forced it into me. Trying to come up with the constant videos, doing constant research into the monetary policy so that I can bring you working class perspective on what is going on and not regurgitating somebody else's information that I got from some other YouTube channel. This is the stuff that I go through regularly, doing my own research and sharing it with you guys. And through my research, I found that the Federal Reserve is communicating in a way that is so different to the mainstream media than it was to the other central bankers out there. Once you see this dual communication that is happening, you realize that they're clear and transparent and, sharing of what it is that they plan for monetary policy going into the future is all about psychological control. Every bit of it. 100% propaganda. All of it is. And once you see it, once you recognize it, and you can recognize it even within the propaganda itself, such as 2% goal, right? As opposed to moderately above 2% for some time to make up for the fact that they failed to achieve the 2% target over the previous 10 years. It's called asymmetric flexible inflation average, or flexible, asymmetric flexible average inflation targeting. There we go. AFIA. You can look it up. Asymmetric flexible average inflation targeting. It's a real thing that the Federal Reserve is using. But nobody really knows it because the Fed doesn't explain that through the mainstream media, because the mainstream media is their propagandized information. The only way you can find it is by doing the deep research yourself. Or follow the Uneducated Economist. I mean, I'm breaking it down for you. All right. Mr. Taco should push robotics instead of tariffs because there is no way businesses can react, hence the extra chicken, but it's killing jobs. In the meantime, just visit the strip mall. Okay. I mean, I think even the understanding that Trump has screwed up the idea of Mr. Taco, right? This is actually benefiting the Federal Reserve's monetary policy. You're actually contributing to the power, right? You're actually contributing to their power by doing that. Now, if people were to understand it to the level that I have, you would not look at the inflation as being a problem, right? It's a problem. It's a problem for our paychecks. It's a problem in that sense. But it's not a problem for the Federal Reserve. It's a complete benefit. In fact, it's what they were absolutely needing. So every time we think of the pain of inflation and the problems that we face with it, think about that pain being their pleasure. They love it. They want you to be in pain and misery and suffering, and the more you feel that it's going to happen, the better their monetary policy is for them. And it's so important to understand that, you know, because if you just stick into the idea that the Fed is causing me pain and misery and they, screw them, I hate them, you're actually giving them more power. You're giving them the power that they are needing and wanting, okay? And the more frustrated you get, the more it leans into their power. All right, Simon, what's your favorite taco? Lengua. My question would be, is good news or bad news these days? So think about it in this sense. Like, if you were wanting to make the economy less restricted, and you know that you're standing still with the Fed funds rate, like, you could lower the Fed funds rate and make the economy less restricted. Everybody understands that lowering the interest rates stimulates the activity. Everybody goes out there, borrows money to buy houses, cars, goes on vacation. People understand it in that fashion, that if the interest rates fall, then that is going to stimulate the economy. Now, the only reason why the Federal Reserve would want to lower interest rates is if there is a bad economy that has taken place. So bad news would then force the Fed to lower rates. Bad news pushes the idea of lower interest rates going into the future, and this somehow stimulates the economy. Now, on the same sense of that, having the Fed stand still and still getting bad news when it comes to inflation or inflation expectations that is going to be elevated going into the future. So this is like bad news, bad inflation news, bad tariff news. This being pushed out there, again, pushes the elevated inflation expectation and raises the neutral interest rate, which makes the economy less restricted. Again, bad news is stimulating the economy. Bad news is good for monetary policy in the sense that it will make it less restricted, whether the people believe it or they don't believe that the Fed is going to, like, they believe that the pain is so bad that they're going to force the Fed to move, right? That'll stimulate the economy, because then they're going to act ahead of the Federal Reserve to try and take advantage of the lower interest rates coming into the future, right? Stimulating the economy. Or it's bad news that is then going to force the Federal Reserve to stand still because of the elevated inflation expectations, raising the neutral interest rate and making the economy less restricted. Bad news is good for the economy, no matter how you look at it. Good news is bad, because good news means, oh man, well, now the Fed doesn't have to move. And now the Fed, like, the idea of the Fed cutting rates on good news is kind of illogical, in the sense of the idea that if the Fed is cutting rates, it usually means that there is a bad economy happening. So cutting rates into good news means that if there is really good news that is happening within the economy, it's lowering the inflation expectations, which people would feel would be good. But this lowering of inflation expectations would lower the neutral interest rate and make the economy more restricted. It would force the Fed to cut into good news. But the economy won't get stimulated by it, because if they're cutting, they're following the neutral interest rate down, which is really still just standing still. What time is it? Do I gotta go yet? All right, guys, I got like 2 minutes left here, so I'm going to read one more comment, and then we are going to go back to work. All right. Will the Fed move at all in June? Don't worry about the Fed moving. That's not the important part. Like I've said this time and time and time again. The very next question you should be asking is, where do you think that the neutral interest rate is going to be in June? Is the neutral interest rate going to be moving up on the elevated inflation expectations and the fear of tariffs over the next month or so? I mean, the neutral interest rate moves slow. It doesn't happen fast, right? So in my opinion, if the elevated inflation expectation is persistent within the mainstream media, and people are feeling it, and people are talking about it, and that's all they talk about is tariffs causing inflation, then you can assume that going into June, the economy will be less restricted then than it is today. Why would they cut? That doesn't make any sense, right? But will the economy be more or less restricted in June if they don't cut? It will be less restricted if the elevated inflation expectation is persistent. Don't think about them moving. It's not about them moving. It's about the words that they use about it, right? If you're focused in on them cutting, even asking the question means that you're not getting any of this, right? Like literally it means that you have missed the entire video. You watched 36 minutes of this and missed it. You should go back and watch it again, because there is no reason to ask whether or not the Fed is going to be cutting in June. If you are asking that question, then you don't understand the credible threat theory, you don't understand the flexible average inflation targeting, you don't understand the neutral interest rate, and you don't understand how it is that they are using market manipulation through perception in order to move the neutral interest rate to make the economy more or less restricted. They want to stand still. They don't want to move. So the idea of them moving is very illogical to think about, because that's not the focus. The focus is on the perception that the people have about inflation expectations, raising or lowering the neutral interest rate. That's what you need to focus in on. Don't ask the question if they're going to cut. If you're asking the question if they're going to cut, you must immediately follow that up with, do you know where the neutral interest rate is? Or where do you believe the neutral interest rate is? Because cutting and the neutral interest rate has to be going together. These two pieces of information must be consistently talked about together. And if they are not, then you're only getting half the story and you will miss it. All right? That's why it's important. All right, guys, I have got to go. This was so good. I really enjoyed this live stream, breaking this stuff down in the way that we have. And I understand that I have been repeating myself over and over again when it comes to this neutral interest rate, but we have to internalize it. We have to be able to understand this stuff and understand these speeches. They are not going to deliberately give you the information, not like I am showing you, but it is out there. You have to find it in the pieces. It's broken up over the years through the documents. And once you start piecing this all together, it starts making a whole lot more sense. Right? I mean, think about it. How could I have called out months ago, before Donald Trump was even president, what tariffs? We have to see what tariffs they're talking about. We don't know what workarounds, what exemptions, what limits. We have no idea what these tariffs are, but we have a profound understanding of the credible threat of tariffs that is definitely pushing the elevated inflation expectation. It's moving the neutral interest rate up, and it's making the economy less restricted. This is something that I had predicted years ago, literally years ago, because it's the Federal Reserve saying this is how we are going to conduct ourselves going into the future. That's the only way I was able to do this. I didn't make this stuff up. It's them telling us, right? But they don't come straight out and tell you. You have to find the information. You have to break it down this way. All right. Thank you very much for everybody joining in on today's live stream. Be sure and check out the podcast. We have the podcast up and running, where if you don't want to watch these on YouTube, you can listen to the audio on the podcast. I have the Patreon up and running. Got quite a few people who are now coming over to Patreon to check out some of the writings that I have done recently. They are great writings. It is me typing these things out, but I do run it through AI to make it like a much easier thing to read. It flows a lot better when I do that, but I guarantee you the information in there is unlike anybody else's, and it is definitely the information that comes from me and the credible threat theory. So check out the Patreon links. I'm loving the stuff that I'm doing over there. What else do we got? The member-only live stream. So we're going to break down this speech, and we have many others. So for $1 a month, literally like the cheapest membership anywhere, you can join the YouTube membership, get access to the member-only live streams where we have broken down these speeches in a way that the average, everyday, and working class individual can understand. We have a conversation about these speeches. And this is, in my opinion, by far the best way that you can then learn how it is that you need to look at the economy to make those appropriate decisions for yourself. Thank you, everybody, for being here. Links are down in the description. Uneducated Economist. You guys let me know.